We're going to pick up where we left off on last Tuesday, and we're going to talk about depreciation. And we'll start with depreciation in income taxes. The IRS does not require taxpayers to use the same depreciation method on the tax returns that it uses in preparing financial statements. In fact, the IRS requires a straight line method or a special accelerated depreciation method that's called MAKERS, Modified Accelerated Cost Recovery System. While you can use MAKERS for your tax return, you cannot use it for your financial statements. You'll learn a lot more about MAKERS if you take tax class or in some of your later accounting classes. However, the difference in them is that in makers there is no salvage value. You also have to choose a time frame that is predefined based off the type of the asset. So although you feel that a piece of equipment may last you 10 years based off that asset, it may have to be depreciated across 7. So you do receive a quicker tax depreciation under makers, often is the case, and to a greater degree. However, keep in mind the quicker that you depreciate it and the quicker you take that tax effect from it, the less of a tax effect you're going to have in the later years of an asset's life. Here we're looking at Southwest Airlines notes to their financial statements. This is where they're disclosing their method of depreciation. So for property, plants, and equipment, they use a straight line method with estimated residual values over periods from 23 to 25 years for flight equipment and 5 to 30 for their ground equipment once the asset's placed in service. Amortization of property under their capital leases is on straight line basis over the lease term and is included in their depreciation and amortization expense. You're not going to learn a whole lot about capital leases in this class. Just know that this is a way that large long-term leases are handled is they're handled in a very similar manner as long-lived assets and depreciation. So sometimes something happens. Um, Life happens. And there's now a difference in the time, um, such as you originally assumed that an asset would be around for 5 years, but for whatever reason, you now recognize it's going to be around for 7 or 8. We can revise depreciation. When we do revise depreciation, what we do is we stop at that book value, keeping in mind the book value is historical costs less the accumulated depreciation to date. We stop at that point and start over. We don't recalculate the depreciation retrospectively. We don't go backwards in time. It's not really an error because what it is that in accounting we have to make estimates. Sometimes we don't have enough information to have the most accurate estimate, but as time goes on, we realize that okay, it's going to be longer or it's going to be less time. Either one can happen or something happens in our market and that's going to change the picture as well. So it's not an error when we have to make a depreciation revision. However, we can do it from that point that we decide to forward only. We don't go backwards. This particular illustration talks about Arcadia High School, who purchased equipment for $510,000, assuming an estimated life of 10 years and salvage value of $10,000 at the end of that time. They recorded the depreciation on a straight line basis. Now remember, that's the easiest depreciation we talked about, same amount every time. Now year 8 rolls around, it's 2017, and they actually estimate that the life should have been 15 years. And that at the end of that time, they'll probably only have about $5,000 of salvage value at the end of the year. What would the journal entry be to correct the prior year's depreciation? And we're going to calculate the depreciation expense for 2017. Now, keep in mind that, as I told you, we don't go backwards. It's not retrospective, it's forward looking only. So there is no entry to correct prior year's depreciation. Now, the journal entry for the depreciation expense for 2017 would be based on new calculations. We start with the original cost of the equipment. We take out the salvage value and created a depreciation base. We gave it an original 10 years, which gave us annual depreciation of $50,000 a year for those 7 years. Now we are in year 7, remember? So we're trying to find what our current net book value is. So that's why we go through this particular step. On our balance sheet, we should have a net book value for that depreciation of $160,000. Now I bet you're thinking, why don't you just look at your balance sheet? Because your equipment account is going to typically have more than just the piece of equipment you're considering revision on. It is an account that's going to hold a bunch of things that came in at different times and are depreciating at different rates. The same for your accumulated depreciation. It's an account that's going to hold all of the accumulated depreciation for all of the equipment assets that you have. So we have to break it out. We have to say this much of it is equipment, this much of it is the accumulated depreciation attached to that equipment. So this is what the net book value is. So now that we determine what the net book value is, we need to go on and we need to look at calculating our depreciation for the year 2017 and future years. So we have a net book value, what it is worth today. Because remember, I told you we stop at that point, and that's our new amounts. That's what we're going to take into consideration. So there's $160,000 in net book value with $5,000 of salvage value now determined. That means that we now have a new depreciable base of $155,000. That is what is left of the original cost that needs to depreciate. There should be 8 more years because remember, we went up to 15, which would give us annual depreciation of $19,375. Depreciation expense would be $19,375. We would debit that because that's how we increase an expense. And then we would post to the contra asset account a credit of $19,375 for accumulated depreciation. Now we're going to talk about impairments. This is actually a concept that most people tend to forget after they leave this class or that they don't necessarily grasp. So let's talk about it. In reality, an asset could have an immediate permanent decline in the fair value of the asset. This can happen for a variety of reasons: obsolescence, market changes, regulations. Anything that can happen at a point in time that can cause an asset to immediately lose a significant value. Now, we don't want to overstate the assets in our books. We want to provide the most accurate picture of the financial position of the organization at an exact point in time. So, in order to do that, the company writes down the asset to a new fair value during the year in which the value, during the period or year in which the decline in the value occurs. So we're talking about long-lived assets here, and we're talking about things such as equipment and etc. So we will go ahead and continue on depreciation. 99% of the time, you're going to find impairment is going to apply to what we call the intangible assets. And those assets are things like goodwill, copyrights, trademarks, things of that nature. we'll take a minute here and we'll look at Chambers Corporation and we'll revise some depreciation. So they purchased a piece of equipment for $36,000. It estimated a 6-year life and a $6,000 salvage value. So to determine the depreciable base of this particular asset, we take the $36,000 that we purchased it for, our cost, and we take out the $6,000 of salvage value we expect to have at the end of the life, meaning that there is $30,000 worth of this asset that we expect to consume or use over a 6-year lifespan. So we take that 30,000 and we divide it by 6 because we're going to use straight line depreciation, which gives us a $5,000 per year depreciation. Now at the end of year 3, before there was a depreciation adjustment, we estimated the new total life actually to be 10 years. Something happened and we recognized that we were going to be able to use it longer than expected. However, we also recognize that we're not going to have as much salvage value. It's only going to be 2,000. So we're going to compute the revised depreciation. First step is that we have to look at the original depreciation expense of 5,000 and recognize how much of it has accumulated thus far. Now, because this is before we have actually entered the depreciation expense, that means that we only have 2 years that we have entered. So we have 10,000 that has been entered against the 36,000. That gives us a book value of 26,000. So book value after 2 years of depreciation is 26,000. We have a new salvage value of 2,000, so we reduce that to give us a depreciable cost or depreciable base of 24,000. We expect another 8 years out of this particular asset. So we take that 24,000 divided by 8 and it gives us $3,000 of annual depreciation a year. Now you've owned equipment for a while. You've had it for its 8 years. You've decided you don't want to have it anymore, so you need to get rid of it. There are a variety of ways that we get rid of our equipment. We can sell it. We can retire it, meaning that basically we scrap it or we throw it away. And then we can exchange it. So we could take a car into the dealership and exchange it for another one. Now, granted, we're going to pay more for the new one, but there is some value laid in there. You get your trade-in value. We record depreciation up to the date of the sale. So if we're recording depreciation annually and we exchange or sell or retire an asset in June, we will record 6 months of that 12 months of depreciation. So that's the first thing we have to do. We have to make sure the depreciation is recorded up to the date of disposal. Then we have to get that actual asset off the books. And to do that is we debit the accumulated depreciation account for the amount of accumulated depreciation associated with that specific asset, and we credit the asset account. Now, this may not be an exact amount at this time. This is where we're going to run into things such as gains and losses. But remember that those two parts we have to do. We have to debit the accumulated depreciation for the total of accumulated depreciation that has been experienced by that asset to date. And then we have to credit the asset account for the cost that was paid for it at the point of purchase. So then what we have to do is we have to look at what that book value of the asset is based off the proceeds of the sale, because we're going to talk about a sale of plant assets. If you have more in the sale than the book value, you're going to get a gain on disposal. You're going to have made money by selling it. However, if it's less, you're going to incur a loss. You're going to have lost money on disposing of the asset. So to illustrate that, let's look at Wright Company. They sell office furniture for $16,000 in cash. The office furniture originally cost $60,000. As of January 1st, it had accumulated depreciation of $41,000. Depreciation for the first 6 months of 2017 is $8,000. So we need to start and we need to record the depreciation expense for July 1st. They told us the first 6 months of depreciation is $8,000. So we have a depreciation expense of $8,000. We have accumulated depreciation of $8,000. So let's go and let's look at net book value and the proceeds from the sale. We have cost of 60. We've accumulated depreciation of 49, giving us a book value on the date of disposal of 11,000. We sold this office furniture for $16,000. It is more than our book value on the date of disposal. So there's a $5,000 gain. So we have to record the actual sale. First, we record depreciation through the date of disposal. Then we have to start recording the sale and the actual removal of the asset. So first we have cash. Somebody paid us for this, right? Of $16,000. We increase our cash account through a debit of $16,000. We have to remove the asset and its associated accumulated depreciation from the books. So accumulated depreciation equipment is debited $49,000. That will remove that amount from the accumulated depreciation account. And then we remove the equipment by crediting it $60,000 for the cost. So we reduce the asset account through a credit. These two don't balance, do they? We have $60,000 on one side and we have a total of $65,000 on the other side. What do you do with the other $5,000? Well, you're going to have to credit it because remember, for all debits, there are equal credits. And that is an account called gain on the disposal of assets for $5,000. Now let's take this and flip this. Let's assume that instead of having a gain, they experienced a loss for the same office equipment. So we have the same book value of $11,000. However, we were only able to get $9,000 for it. Well, now we have a $2,000 loss that we need to record. We received our cash of $9,000, increase our cash account by debiting it $9,000. We still have to remove the accumulated depreciation equipment by debiting it $49,000. And we have to remove the equipment by crediting it $60,000. However, we have $60,000 on one side if we ignore the loss line. And then we have $58,000 on the debit side. That $2,000 of debit is what we're accounting for. That's a loss on the disposal of plant assets. Sometimes when you're going to do a problem like this, it's easy to understand I increase cash with a debit. I need to remove the accumulated depreciation, so I need to reduce that contra account. And in order to do that, I have to debit it. That's easy. We know how to reduce an asset through a credit. So what I would do is I would actually work this in pieces and parts. I would put the cash line, I do the accumulated depreciation. I know I have the equipment. I do the math. Okay, I'm looking for 2,000 and I'm looking for it on my debit side. And then you start working through it in your mind and you're like, okay, yep, a loss would be like an expense. It would be a reduction to total net income. So a loss on a disposal of a plant asset would be $2,000. Now, when you retire it, remember this is when we scrap it and just get rid of it. No cash is received. So when no cash is received, we decrease our accumulated depreciation account for the full amount of depreciation that had been taken over the life of the asset. and we decrease or we credit the asset account for the original cost. I'm sorry, forgive me for that. So let's look at Overland Trucking. They have an old truck and it had cost them $30,000 when they purchased it. It has accumulated depreciation to date of $16,000. We're going to look at two different situations. First, if the company sells the old truck for cash, and then second, the truck is deemed worthless, so the company just simply retires it and scraps it. So for scenario 1, they sell the truck for cash, $17,000. You know you received cash of $17,000. You know you have to remove the accumulated depreciation, and that's going to be a debit of $16,000. That's going to provide you with equipment of $30,000 that we're removing. $30,000 to $33,000. We're currently not balanced. So we have a gain on our disposal plant assets of $3,000. Now for scenario 2, let's talk about if the truck is worthless. Engine's blown, tranny's done, we're just going to take it to the scrap yard. The entries to record this scenario. You know you have to remove the accumulated depreciation, and that's a debit of $16,000. You know you're going to have to remove the cost of the truck as a credit of $30,000. We have $16,000 and we have $30,000. Those two don't balance. Our debits and credits aren't going to be equal. There's a $14,000 delta of variance that we need to account for. It's going to have to be a debit. That would be a loss on the disposal of plant assets of $14,000 that you would record to account for the full historical cost value of the equipment of $30,000. Now we're going to talk about impairment. You know, we talked about impairment. I told you that is something that permanently declines the fair value market of an asset. Most of the time, it is attached to intangible assets. Can occur with some others, but we see it a lot with intangibles. Now, intangible assets are rights, privileges, advantages that are the result of long lived assets that don't have physical substances. It's not something you can touch, pick up. You don't use it to actually create something in the sense of like you use equipment to make something. Intangible assets can have both a limited life or an indefinite life. One of the two is going to come into play, and how we treat them depends on that. So, some common types, things you've heard about before: patents, copyrights, trademarks, trade names, goodwill, franchises or license. Patents are huge. So, if you stop and think about it, patents have a certain lifespan. Once a patent has expired, then another company can come in and create something similar. This is how we go from those brand name drugs to those generic drugs. So the original patent expires on the newfangled drug to clear up acne. So for a certain period of time, only the owner of the patent can create that particular type of a drug based off the things that are in the patent, and that's going to be chemical structure and things of that nature. Now, once the patent expires, what often happens is that during the life of that patent, other drug companies have been working to reverse engineer this drug and create the exact same drug. Once they're able to recreate that drug by reverse engineering it, they can offer that same chemical composition for a lesser price. They don't have as much invested in it as the original company. When the patent expires, they can bring that to the market and offer it as a generic version. So until a patent expires, you're not going to have a generic version of a drug. Copyrights technically have a limited life. That is on the written word, that is on the on art such as my brain turned off for a second there, music, forgive me. Franchises or licenses. So a lot of businesses actually operate underneath a franchise. For example, most McDonald's are actually franchise locations. The same thing with Burger King's and even some Starbucks are franchise locations. Trademarks are something that you have registered to associate with your particular company. Trade names are specific names that you are operating under. And goodwill's a little bit more of a complicated thought process. And you encounter goodwill when you purchase another company in whole. So I buy company A and I pay $500,000 for company A. However, the sum total of all of company A's assets are really only $300,000. I'm paying a $200,000 markup or premium. That $200,000 is the goodwill for me. Well, that's what I will recognize it as in my books. It is the reputation, it is the composition of the employees, it is the demographic market, it is market share, it is a lot of things that you cannot necessarily assign a dollar value to, but have value for your particular company that you are selling. So for limited life intangibles, with those, we do what we call amortization. Um, Amortization works very much like depreciation, just different word, and we calculate it in a similar manner. So we credit the asset account directly. We typically will go straight to the asset. However, you can, and I have seen it in practice, have an accumulated amortization account on the books, similar to the accumulated depreciation account. It would be, again, a contra asset account. For those that are deemed to have an indefinite life, there is no foreseeable limit on the time that the asset is expected to provide you with cash flows. If it has indefinite life, we don't amortize it because its value isn't going to change. We're not consuming it. So we'll start with patents. A patent is an exclusive right to manufacture, sell, or control an invention for a period of 20 years from the date of the grant of the patent. So for 20 years, you are the only person that can create that specific product. As you end 20 years, you're going to now have competitors. So through that time frame, that 20 years when you can sell it, you're the only one that can sell it. The patent is providing you with the exclusive right to specific cash flows. So the first thing we do is that when we are acquiring the patent, we capitalize the cost of purchasing it. Then over that period of time, either 20 years, which is the useful life, which is the granted life of the patent, or the useful life. So, what the difference could be is perhaps this is something that might only be a little bit more trendy. We expect it's only going to be around for 10 years. That would be useful life. Whichever one is considered shorter, that is the period of time you're going to use. This is only the actual costs that are associated with the patent itself. This is not the research and development costs that we went through for the prior 5 years in developing the patent. We will expense in the current period any research and development costs that are incurred because Research and development is not guaranteed to yield you any type of cash flows. There is no guarantee that when you are researching something that you are actually going to create a usable, saleable product. It is only after the patent is granted that you have something that is usable or saleable, that you will have cash flows associated with it. So, all those costs up to the patent phase. So, while we're exploring, those are expensed in those time periods. It is only those legal costs that are associated with purchasing the patent that we capitalize and amortize over its useful life. Now, sometimes, and we've heard about these in the news, you're going to be sued because somebody's going to say your patent violates something about theirs. They are trying to uh, ascertain that their product pre-existed yours. Legal fees that you actually have to pay out, that you experience in the process of successfully defending your patent, are then added and capitalized to the patent account. So they will also be amortized over whatever the remaining of the 20 years or useful life is, whichever is shorter. So let's look at a patent and how we would handle that. So National Labs purchases a patent at a cost of $60,000 on June 30th. They figure they're going to have the useful life for a remaining 8 years. Let's prepare the journal entry to record the amortization of their 6-month period ended December 31st. So first we have the original cost of the patent, right? $60,000. Patents, we amortize 100%. We don't expect them to have residual value. So we know that we need $60,000 to amortize over the course of 8 useful years. That's going to give us $7,500 of annual expenses. That's $7,500 per year. We need to discover what 6 months is. So we multiply that by 6 divided by 12. Our time frame we're looking for in the course of a full year, 6 divided by 12. And that gives us $3,750 for the last 6-month period of amortization. So we have an amortization expense of $3,750. And as I said, in the case of intangibles, you can post directly to the asset account. You don't have to have accumulated amortization. You can have it, but you don't have to have it the way we do with the other types of assets. Oh, excuse me. So we post a credit to the patent account of $3,750. So let's think about those research and development costs we talked about that don't necessarily guarantee or yield a saleable product or future cash flows. So when we are seeking a patent, we are seeking a copyright, we're looking for a new process or possibly a new product. We're going to go into research and development. We're going to have people working to try to create something new, to bring about the new process. And as that occurs, we are in a gamble. We don't know that this investment is going to yield us anything. Our intent is that it will, but we don't have any type of cash flows that we know will be associated with that. So for accounting purposes, all those R&D, those research and development costs and expenses will be expensed. They will be placed on our income statement as a research and development expense at the point in which they are actually incurred. They're not intangible costs because although they may lead to patents and copyrights, there's not a guarantee that you will be granted a patent copyright. If you are in research and development and you're working on some type of a new product and you happen to be working on the same thing that somebody somewhere else is working on, you both have the same new great idea. That person may acquire the patent before you finish your research and development, and you didn't realize that he was in that process. Thus, you may not get a patent for everything that you have invested. As I said, this is the gambling phase of future cash flows. So, we talked about patents already and that exclusive right to manufacture and create a specific product. Let's talk about copyrights. So, copyrights give the owner of the copyright the exclusive right to reproduce and sell some type of artistic or published work. Now, when these are granted, they are granted for the life of the creator plus 70 years. We capitalize the costs of acquiring and defending it, and then we amortize to expense over the useful life of the copyright. Although copyrights look to have an extremely long life, that may not necessarily be the case. You also have to take into consideration that some things you are only going to publish for so long. So let's talk about the life of the creator plus 70 years. And I'll point out a specific author that I happen to know. So I have a specific author that I have read for over 20 years. She's my go to for light reading, something to just decompress at the end of the day because I don't have to put a ton of thought into it. Much different than having to read your accounting textbook. Her name is Nora Roberts. Early in her career, she was attached to a publishing house, and that publishing house actually owns the copyrights of her books. So we have the life of the creator plus 70 years. So when she was in her 20s, she wrote some small novellas, and the publishing house does not necessarily publish that book for the next, as she's 20 years old, the average lifespan, say, is 70, so that's 50 years. They're not going to publish it for 120 years. They're not going to have a market for that specific type of book for 120 years. So that's why we look at the useful life. They do have the exclusive right to reproduce it for that period of time. However, they're not going to publish it and they're not going to have cash flows from it over that entire time. Useful life is the period in which you expect it to generate you cash flows and revenue. So here is another type of tangible assets, trademarks and trade names. You should know these. These are the things that brands invest a lot of money in order to stick in the consumer mind. They can be a word, a phrase, a jingle, a symbol, something that is going to associate and distinguish and identify either a specific enterprise or a specific product. So let's stop and think about that for a minute. If I say, just do it, what comes to mind? Nike. If you see that little blue cross looking thing, what car manufacturer do you think of? How about the Under Armour logo? Do you associate it with anybody else? These are only just a few of the different types of trademarks or trade names that come into play. So, what happens is when a company establishes a trademark, the Golden Arches, the Big Mac. Think Taylor Swift copyrighted Shake It Off. They're granted legal protection initially for 20 years. They're given 20 years. However, they have the right to renew that 20-year period for another 20-year period, so on and so forth, indefinitely. They just have to pay their fees. Now, going through the process of doing this, you capitalize what we call the acquisition costs. Now, this could be you actually buy this same exclusive right from somebody else. In 60 years, somebody else wants to use Shake It Off. So they go to Taylor Swift and they buy her trademark. Now, it may have only really cost her a small amount of money to legally establish that trademark, but it has value for her and she can sell it for more. So for the company that buys it for, say, $1 million, they would capitalize that million. They now own the legal protection for an indefinite number of 20-year renewal periods. Because it is indefinite, there is no amortization. There is no consumption allocation assumption that we would need to make. That is a lot of words that end in ION. My apologies. Franchises. This is a contract between the franchisor and the franchisee. Some popular franchises are Toyota, Shell, Subway, and Marriott. Best Western, La Quinta. Those are some others that are associated with the lodging industry. McDonald's, Burger King, some Starbucks. Phillips 66 has franchises. Come and Go, Conoco. We could go on all day. Most of the large corporations actually have franchises that are attached to them if they are selling something. Now, the franchise, which is a license between the two people, has a limited life and it should be amortized over the expense of the established life of the franchise. This is when you sign a contract that is a 5-year franchise. Now, you may enter into a franchise that might have an indefinite life. In that particular instance, you're going to carry it on your books at costs and you're not going to amortize it. We're going to talk about goodwill next. And goodwill, as I said, is kind of a complicated manner. It only happens when you purchase an entire business. And what the value of the goodwill represents is exceptional management, the location. You've heard in real estate, but also in business, it really is location, location, location. Customer relations, this is the particular reputation that a company has established with their customer base, their employees, their high quality products. It really could be a whole host of things that are associated with that very specific business. When somebody purchases them for in excess of the fair market value of their identified net assets, whatever the amount is in excess of that of the purchase price is the goodwill. As you are in business, you have started your own company and you're establishing that. You have really good employees, they're highly skilled. You have a good demographic customer base, you have a great relationship with your customers. You don't capitalize and you don't record that internally created goodwill. You only recognize it when you purchase a business in its entirety. So I'm going to let you take a minute here, and I want you to read these three definitions and figure out which one of these belongs to which one. I'm going to go ahead and time this and give you about 5 minutes to look at these. Okay. So let's talk about the allocation to expense of the cost of an intangible asset over the asset's useful life. When you hear intangible and you hear the allocation expense, I want you to think amortization. Number two, rights, privileges, and competitive advantages that result from the ownership of long lived assets that do not possess physical substance. When you hear assets that do not possess physical substance, they are intangible. You can't actually touch them. And then the exclusive right granted by the federal government to reproduce and sell an artistic or published work. That would be a copyright. So we have a couple more, but we'll go ahead and work through those together. The right to sell certain products or services, or to use a certain trademark or trade name within a designated geographic area. So when it's talking about a right to sell, use something in a designated geographic area, I want you to think franchise. Costs incurred by a company that often lead to patents of new products. These costs must be expensed as they're incurred. Leading to or may or often can. There's your gamble. These costs expensed as incurred are research and development costs. So here we're going to discuss how long-lived assets are reported and analyzed. So you'll notice that property, plants, and equipment are in their own classified section. Here we have it represented with the various types of assets: land, buildings and improvements, machinery and equipment, and other types of assets. And then one cumulative accumulated depreciation account. They are recognized at net book value. Here, as you can see, with 25,258 in total assets, less that accumulated depreciation of 10,625, for net book value of property, plants, and equipment assets of 14,633. This is typically how you will see it. Now, there's also the intangible assets classification. These are kicked out. They are long lived, like property, plants, and equipment, but they are reported separately in their own section of the balance sheet. You'll notice that they are identified on whether or not they have indefinite lives, and they are listed one after the other. This particular type of company, Coca-Cola, does not use an accumulated depreciation account, accumulated amortization account. My apologies. So they are posting directly to the intangible asset when they recognize their amortization. Now, we've already started exposing you to all the different types of ratios there are. So, return on assets is the amount of net income that is generated by each dollar of assets. So, you take your net income and you divide it by your average total assets. Assets at the beginning of the period, assets at the end of the period, divided by 2. So, here we're looking at JetBlue Airways. We have their 2014, which is 6.8%, which is a far cry higher return than 2013, which was 2.3%. We always want to look at our closest competitors to see how we are trending in relation to them. It may not be an apples to apples comparison based on the composition of the company, but it kind of gives us just a general idea. Southwest Airlines is 5.7%, so we are functioning better than Southwest Airlines. And then let's look at the industry average, which is 4%. The industry average is a great number to use, but always keep in mind sometimes there's something in there that can significantly skew that. In your own time, I want you to come back to this slide on Canvas, and I want you to go ahead and give it a quick read, talking about marketing the return on investment as a profit indicator. We're going to move over into some more of the ratios here. Let's talk about asset turnover. This is how efficiently a company uses their assets to generate sales. The whole purpose of your assets is to generate sales or generate income. That is why you have them. The more efficiently you do this, the better your operations are. Now, there will be times where your efficiency will decrease, and that may be because you are ramping up for something. However, this is a great indicator in which the higher the number, the better. JetBlue Airways is improving because they have asset turnover of 0.77 times compared to 0.75. It's a minor increase, but it is an increase. However, when compared to Southwest Airlines or the industry average, they are not performing nearly as well. Now, we talked about profit margin in prior classes. This is how effective a company is at turning their actual sales into income. So they have their sales revenue at the top of their income statement, and then they have net income at the bottom. This tells us how much income every single dollar of sales is going to provide. So to do this, we can take profit margin times the asset turnover. Now you'll notice, and I know that I have told you before that I swore I would never use algebra and I would never use some of that complicated math every day of my life, but I do. That we have a fraction multiplied by a fraction. When you're multiplying two fractions against each other, you can cross eliminate. So we have net income from the profit margin divided by the average total assets. When we do this for JetBlue Airways and Southwest Airlines, we get a return on assets of 6.8% for JetBlue and a Southwest Airlines of 5.7. Southwest was more effective at generating their sales from their assets. However, JetBlue is better at deriving profit from its sales. So this is a great way to show you that it's not a single ratio that paints the picture. If you think of a single ratio as one color in a color photograph, you need all of the colors in order to make the full picture. So here we're going to use Paramar Company, who has net income of $180,000, net sales of $420, and total assets of $460 on January 1st, 2017. Now they had total assets on December 31st of 2017 of $540,000. So let's look at what their asset turnover is. We have to take their net sales. So they had net sales of $420,000. And then we need to divide that by the average total assets. We have average total assets of $460,000. That is January 1st, 2017 total assets plus December 31st, 2017 total assets divided by 2. When we carry this calculation all the way out, we get 0.84. So we did actually look at the declining balance and the units of activity method in a earlier objective. We looked at that last week. Some of the things I always want you to keep in mind is the IFRS and the GAAP convergence. Where are we similar and where are we different? Those of you that remain within the US may still have a need to understand what those differences are. You might go to work in finance. You need to know where the differences lie and where the similarities lie. So the basic definition for plant assets is basically the same under both IFRS and GAAP. They both follow the historical cost principle when accounting for plants, property, and equipment, which we'll often call PP&E, and it's at the date of actual acquisition. So it's what you actually paid for it, including those expenditures that are necessary to acquire the asset and get it ready for its intended use. Both IFRS and GAAP recognize that there are changes in the depreciation method used. They also have interest costs from construction that we capitalize. Recently, IFRS converged to GAAP in this area. So we're not only moving in line with them, they are moving in line with us. Now, those additional expenditures, ordinary repairs, basic additions, are treated the same under IFRS and GAAP, and those subsequent expenditures are expensed in the period in which they are incurred. The IFRS also takes the view of depreciation as an allocation of cost over an asset's useful life. They permit the same basic depreciation methods as GAAP, such as straight line, accelerated, and units of activity. They both recognize that there are changes in depreciation methods and changes in useful lives that can occur, and they're handled for current and future periods and not posted retrospectively. Prior periods are not affected at all. GAAP recently conformed to the international standards for changes in depreciation methods. The basic accounting for plant asset disposals is the same under both. And the definition for intangible assets is basically the same under both. So, when looking at accounting for exchanges of non monetary assets, this is a little bit above and beyond your particular pay grade at this point, but we had a recent convergence between IFRS and GAAP. GAAP now requires that gains on those exchanges of non monetary assets be recognized if the exchange has what we call commercial substance. This is the framework that's used in IFRS. Now, we wouldn't be the US if we weren't contrary in some ways from everybody else. So, IFRS uses the term residual value instead of salvage value to refer to an owner's estimate of the asset's value at the end of its useful life. They are basically synonymous, but they are different terms. So, this is a difference between the two. IFRS allows companies to revalue their plant assets to fair value at reporting dates. Companies that choose to use the specific framework must follow some defined revaluation procedures. If they use it, it must be applied to all of the assets in a class of assets. Assets that are experiencing rapid price changes must be revalued on an annual basis. Otherwise, if they're relatively stable, less frequent revaluation is acceptable. The US does not allow for revaluation for price changes on your plant assets. IFRS requires component depreciation. This specifies that if there are any significant parts of a depreciable asset that have a different estimated useful life, they should be separately depreciated. We do not typically use component depreciation under GAAP, however, we do allow for it. As in GAAP, the IFRS costs associated with research and development are segregated into two components. There's the costs in the research phase, which under both IFRS and GAAP are expensed. However, under IFRS, costs during the developmental phase are capitalized as development costs once technological feasibility is achieved, whereas those continue to be expensed underneath GAAP. IFRS allows for the revaluation of intangible assets with the exception of goodwill. GAAP does not allow us to revalue are intangible assets. Keep in mind that IASB and FABSB have identified a project in which they would consider the expanded recognition of internally generated intangible assets. IFRS permits more recognition of these compared to GAAP currently. We'll go ahead and just move through those. I want you to realize that I expect that most people's homework will actually be late. No one will be docked for that. Go ahead and get your homework completed for this chapter, and I will see you on Tuesday.